sharp focus. I mean, the previous low was 83.3, and around there was a fair bit of chatter that the RBI will defend that level. I mean, we'll see, but it's opened weaker against the USD. Here on the index, not very much. It's just a 40-odd point cut at this stage. More stocks in a bit from now. We've Nilesh Shah, who joins in. He's Managing Director at Kotak Mahindra Asset Management Company. Nilesh, great to have you with us here. Appreciate your time. I hate to start with not negative, but the results are for the third quarter, and we're only at the fag end now, almost done. It's not a very encouraging picture. I mean, actually, one can ask the question, where are the upgrades based off this quarterly earnings season for FY24 and beyond? There are more downgrades, and you had alluded to this in the middle of the third quarter when we had spoken that maybe profitability, matrices, etc. are deteriorating at the margin. Now with Q3 behind us, what are your thoughts, Nilesh?
So undoubtedly, Prashant, the broad results are in line with market, but that's only because of superlative performance from banking and financial services. Moment we remove the BFSI, there are few exceptions here and there, but by and large, companies have given results which are little below expectation. In fact, yesterday and this is more in a lighter way, it seemed Alan Greenspan used to track what was known as innerwear index. He'll try to figure out based on the volume of innerwear what's happening in the economy. And if you look at the listed innerwear companies' results, they all are showing volume degrowth, not turnover degrowth, volume degrowth. So certainly there is a cause of concern at the below expectation results for many of the companies in September 22, as well as December 22 quarter. In some cases, it is coming because of the margin pressure. In some cases, it is coming because of volume growth not materializing as expected. Obviously, market is looking forward now to the March 23 quarter. Let's hope and pray that the subdued trend of September and December 22 gets reversed in March 23.
Okay. Nilesh, hi, good morning. Great to have you on the show. I wanted your thoughts on one particular pocket, which is the new age tech companies. Now, there is a path to profitability that we're seeing here, especially, for some of these companies, whether it's Paytm, Nykaa, to a certain extent, even Zomato. Do you think that the time has come to nibble into these stocks, raise allocation here, or would you stay away entirely?
So one, these are high risk, high return bets. Number two, here you'll have to be ready for much higher volatility than a normal stock. Number three, choose those stocks which have deep pockets. Your business model, may not be able to survive unless until your sponsors are going to put capital into this. And most importantly, always keep dry powder to average into these stocks. So we are tasting the water. We have our own path to profitability for many of these companies which we cover, not necessarily we own. And every quarter when the results come, we try to upgrade those models to figure out, are the companies reaching to paths to profitability at a faster pace or a lower pace? If they are faster pace, then we try to add something at our prices. If they are at slower pace, then we try to restrain. Essentially, be ready for higher volatility. These are high risk, high return bets. And you have to be creating a portfolio rather than selectively going in for a stock, because you never know which one will succeed.
Nilesh, we get monthly data for flows into mutual funds. And we've spoken about this in the past, right? A whole new wave of new investors came into the market after COVID, during lockdown, etc. And they've stayed. The numbers kind of bear that out. At least the SIPs are going strong. They're very strong. But what is your sense? I mean, is that in your assessment, a secular kind of a trend, or if markets, they're already down on a one-year basis, no returns actually on a one-year basis, more than 1 year now. Will that also come under a bit of threat question? Your sense?
So, Prashant, I'm like a barber whom you are asking whether you need haircut or not. As mutual fund manager, I'm going to say that yes, mutual funds are here to stay.
No, mutual funds are here to stay, but I'm saying
data. And the flows are here to stay. But let me give you some data. As per SEBI's own research, 89% of investors lose money while trading, and only 11% makes money. This 89% which lose money is far more than what 11% makes money. If we do similar kind of research on mutual fund investors, long-term investors, I think the ratio will be almost 100% making money. Now, this is creating word of mouth publicity. A parent will advise their kids who are starting their financial journey, beta beti ek SIP kar lijiye. SIP is now becoming part and parcel of everyone's life. And thanks to the mutual fund distributors, this SIP investor, along with existing investment, is creating a beautiful pattern. In a market which is expensive, we get SIP minus redemption. I net have to invest 1,000 to 2,000 crore a month. In a market which is cheaper and falling, I get SIP plus subscription. Suddenly, I have to invest 25,000 crore a month. This pattern is too good to ignore. Thanks to all the mutual fund distributors which have educated investors, and which is where I believe going forward, the bottom of the market will happen faster than what we can expect. At the same time, top of the market also will happen faster than what we can estimate. The range will become narrower going forward thanks to the maturity of mutual fund distributors and investors.
Okay. By the way, I just want to mention Bharat Forge is really taking a knock. It's a 7% fall that we're seeing on Bharat Forge. We were telling you in pre-opening how there are a lot of brokerages that are now very cautious on the stock because of the subsidiary losses that we've seen in the overseas business, as well as debt has been piling up for the company. So the street definitely doesn't like that. Some downgrades coming through from Nomura this morning as well.
So even the data, right? I mean, the Class 8 truck orders, and I put that question to Mr. Kalyani yesterday. For January, this is the fourth quarter, not the quarter for which they've reported. They're sharply down. I mean, they're down 25% month on month. Over December, January is down 25%. And you know, of course, Mr. Kalyani said, well, you know, the current order book is already is good for 1 year, so they're okay. But not good at the margin. I mean, it's negative. I mean, markets get excited when this number comes very strong. So it should be so that it's the opposite when it reverses.
But I think there's a common theme here, right? And Nilesh, I wanted to get you in on this. Europe and the global markets are still under quite a bit of pressure. Every company that has an exposure there, whether it's Tata Steel, whether it's Bharat Forge, a whole host of others in the pharmaceutical space, are indicating that the worst is not over in terms of a fall globally. What do you do with such names if you have them in your portfolio?
I think this is time to accumulate such names. We believe, as per IMF forecast, most countries are bottoming out in terms of GDP growth. The probability of recession in US, as per one research report, is down from 70% to now less than 20%. In Europe, also natural gas and other energy source prices are lower than Russia-Ukraine invasion. I believe GDP growth is reviving from the bottom in Europe as well as US. Global growth from the bottom will now be positive in terms of direction. And this will mean that global commodity companies or specialized companies should see better volume, better margin in the days to come compared to the depressed expectations. In terms of pharma, the real challenge is the distribution monopoly in US. There are no more than 3 players which control bulk of the market. Despite providing 45% of medicines consumed by Americans in volume, we don't get more than 10% of the total, value spent by American consumers. Now, this shows the margin or the power of distribution companies. Until such time there is an equilibrium between manufacturer of medicine and distributor of medicine in US, one will have to be a little bit cautious on the pharma companies which are present in US or which are exporting to US.
Okay, all right, Nilesh, always good hearing your thoughts. Thanks so much for joining in. And as you said, for Beta and Beti, it's become a way of life. The SIP, we continue every month, and hopefully, things work out to the positive 15, 18 years down the line. Thanks so much for joining in. Well, let's move on. Let's invite RVNL. Well, they posted a rather weak set of numbers in terms of execution. The revenue this quarter came in completely flat after 7 straight quarters of high double-digit growth. The company's margins as well contracted to around 5.5% from around 6.3% odd. Well, Mr. Rajesh Prasad, the Director of Operations of RVNL, joins us. Hi, Mr. Prasad. Good morning. Thanks so much for joining.